A very warm welcome to almost 400 of you that have registered for our inaugural virtual client conference. This is our 6th annual conference, and whilst due to COVID, we unfortunately won't be able to meet you in person, we are delighted that you're able to join us over the next 2 mornings for what we hope will be a very informative and thought-provoking conference. For those of you that don't know me, my name is Alan Nowick, and I've been with Credo for almost 21 years, fulfilling the role as Managing Director. A great deal of you have been valued clients and business partners of Credo for many years, so please bear with me as I give you a brief overview of where our business is today. We have 2 distinct business units, one which focuses purely on private clients, and one that provides a highly technical platform to our financial intermediary clients. Together, we have over 3.8 billion pounds of assets under custody, represented by over 6,000 clients from all around the world. Our London headquarters of Regent's Park is home to 75 highly skilled staff, with an additional 25 staff based in our 3 South African regional offices. The principles that form the cornerstones of our business are to provide our clients with personalized service, focus on long-term success, and to build relationships based on trust and integrity. This has resulted in a meaningful and lasting partnerships with both private clients and financial intermediaries alike. We are proud of our independence and the ability it gives us to create successful partnerships and to do business in a way that best suits you, our clients. I would like to point out a slight yet very material change in our agenda description today. Charles van der Merwe, who heads up our platform business and will be presenting later this morning, was last week promoted to the position of CEO of Credo. We are delighted to have Charles at the helm and would like to thank Roy Ettlinger, the outgoing CEO, for all his years of dedication to our business, to our clients, and to all of our stakeholders. Roy will be taking on the role as chairman and will continue to manage a number of strategic accounts as well as managing the Credo Growth Fund. I'm shortly going to hand over to Deon, who will give us an overview of the global financial markets in the context of COVID-19 and provide a perspective on the upcoming US presidential election as well as its impact on markets. Deon joined Credo in 2012, and prior to that was the Chief Executive Officer of RMB Asset Management. He qualified as a chartered accountant in South Africa, is a CFA charter holder, and holds a postgraduate degree from the University of Cambridge. He's a prolific runner, having run 57 marathons and 29 ultramarathons. That's over 4,000 miles of racing. So whilst St. Kitts is on the quarantine list at the moment, nothing stops Deon from running back to London from his holiday there. Unlike Bill Gates, who takes himself once a year to a lakeside retreat for his thinking week, Deon tells me that most of his thinking time is spent pounding the pavements, and COVID has provided him with an ideal backdrop to get even more miles in. A few housekeeping issues before we start. Please use the chat button to post any questions during the course of the conference, and we'll attempt to get back to you as soon as possible. In addition, I don't need to advise you where the bathrooms are or the fire exits are, or to turn off your mobile phones to silent. So without further ado, please welcome our Chief Investment Officer, Deon Gouws.
Thank you for that kind introduction, Alan. Much appreciated. Ladies and gentlemen, good morning, and thank you to you as well for logging on to what is our first ever virtual Credo Client Conference. Whilst it's a privilege to be meeting in this forum today, I do hope that the world will return to some semblance of normality again in the not too distant future, and we can hopefully do this again in person sometime soon. If you look at this introductory slide of mine, you may be wondering what that picture is all about. Now, of course, that is a map of the world with all the countries and appropriate social distance from each other. And if you look closely on the left-hand side here, I don't know if you can see my cursor moving, but that is roughly where St. Kitts is. And all I can say to Alan is I wish I was there today to be on a running break, but hopefully we can fly again soon enough, and I can do so. I was looking for a picture that symbolizes the year that we've been through and eventually settled on this one. It's a street scene from Paris in the summer, a street cafe, and with those teddy bears all being positioned so that people can remain a safe social distance from each other. And whilst it may be exciting if you're a 4-year-old to be dining like this or having a coffee with your parents. It really has had a devastating impact on businesses around the world in entertainment, leisure, and otherwise. And we'll talk a little bit about that today. So I do think, as I say, a picture that sort of symbolizes the very weird 2020 that we've been through. Just a summary, no doubt you've seen the numbers, but this is updated as of earlier this week. We nudging towards 40 million worldwide cases of COVID-19 now, more than 1 million deaths. And it has indeed been a devastating disease spreading its way around the world. And the last thing that I want to do is to concur with any of these headlines that go back to January and February this year, all of which boils down to the fact that coronavirus or COVID-19 is not as bad as what people make it out to be, that it's no worse than the flu. I'm certainly not in that camp. If you look at this supplement to the New York Times going back to May this year, when the US got to its first 100,000 cases, of course, it's more than doubled by now. But they listed the first 100,000 names, and in total, it ran to 4 pages of fine print. That is an incredible human toll. At a personal level, I've been spared this in my own family. But one of my close friends who was in one class with me at university, not at university, at school actually, for 5 years, had the disease a couple of months ago, and he had it badly. He was in intensive care for more than a week. I spoke to him a couple of weeks ago. He's still suffering from what they call the long COVID symptoms. The same friend of mine lost his brother a few months before to COVID-19. His brother was a few years older. And I'm mentioning that so that no one thinks that I'm taking this lightly. But in the end, I do think that the response to the disease, ultimately from a business, economic, and at least on a temporary basis, from a market's point of view, has been slightly overdone. I mentioned a minute ago that the US is up to more than 200,000 deaths. This was analysis done by Just at Heart in the US based on information from the Insurance Information Institute of America. This was when the US had reached more than 164,000 deaths. You can see that total on the bottom left here. And he analyzed it by age category. And I want to focus on just one age band there, because I have it in good authority that the largest proportion of this audience today would perhaps fall into that category. I make it myself just at the bottom end of that. And if you just look at the numbers, if you get COVID-19 without comorbidity, your odds of ultimately dying from it will boil down to about 1 in 10,000. And that is about the same as dying in a motor vehicle accident in the US if you use your car every day for a year. And ultimately, that's just one example. You can look at the other examples going up and down that list. Obviously, it's a lot less dangerous if you're younger, and it's more dangerous as you get older. We all understand that. And the reason I show this is simply to say that I think one has to have some sense of proportionality in your approach to the disease. If you look at the COVID cases just in the UK, which of course is close to our heart, I'm talking to you today from our offices in Marylebone, and I updated these numbers yesterday. So these are the official numbers as of yesterday in terms of new cases in the UK. And you can see that the number of daily cases, new cases, is about 17,000, and that is a large multiple of what we had at the peak in April, more than 3 times. Now, of course, that sounds like terrible news, and that's why we've now got new lockdown measures in the UK being announced on nearly a daily basis in different regions. But if you do look at the number of deaths and at the shape of the graph there, you can see that even though it's been ticking up of late in the last week, the last couple of weeks, it's still a relatively small fraction of what we experienced back in April this year. And the bottom line is more younger people are getting the disease now, there's better treatment, and ultimately it's therefore considered to be somewhat less dangerous. And therefore I would suggest maybe we should take that into account in our response as well. Of course, the politicians will tell you that they're following the science, and that is why they are implementing new measures such as the Rule of 6 and other versions of lockdown. The problem with that being that when you do follow the science, there are different scientists actually saying different things. And I would suggest that perhaps politicians should have a slightly more open mind when it comes to following the science and implementing measures as a result. But be that as it may, the version of science that has been followed has led to this tremendous lockdown, and there's been lots of pictures that I can show you about this, but I chose what is arguably the most famous and, for the most part, the busiest street corner in the world, Times Square in central Manhattan. And this is what it looked like in commuting hour on the 19th of March, a few days after lockdown had been announced in that city by the local authorities. And of course, with the devastating impact of COVID, it was always going to have lots of consequences. But what's probably even worse, I think, is the economic impact based on all the measures that we've seen around the globe. Just focusing on the UK, and this is a graph that goes back more than 300 years. It was released by the Bank of England, the OBR, the Office for Budget Responsibility, in mid-April. And you can see there that over the last 70 years or so, since the Second World War, you can see how few recessions we've actually experienced in the UK. And if you just then look at the bar on the right-hand side, the recession for this year, the contraction in economic growth, you can see how tremendous this is in double-digit figures. Not only more than what we've seen in living memory, but in fact worse than anything that we've seen since 1709. Of course, the same OBR has given us their forecasts for what's going to happen next year, the increase from a slightly lower base. And you can see that it's forecast to wipe out the base effects and to show fairly strong growth next year. And all I can say is that we can cross our fingers and hope that indeed we achieve those numbers. I'm going to show you a similar graph also for about 300 years. And this was released by the Bank of England on the 12th of March. And this is a summary of UK share prices, the 3 monthly change in UK share prices for the last 320 years. And you can see there what COVID-19 did up until the 12th of March. It was a worse decline in terms of the share price index than anything that we've seen since the bursting of the South Sea bubble in 1720, exactly 300 years ago. So that is indeed a tremendous drawdown, something that none of us, I think, could have thought that we'd experience in our lifetime. And just to put it into perspective, that is how it compares to the bursting of the tech bubble in the early part of the millennium. And you can see this is the global financial crisis of 2008. You can see how much worse COVID-19 has been in the UK, but also around the world. As I said, this was released by the Bank of England on Thursday, the 12th of March. On Friday, the 13th of March, is when we got the news from the BBC that English cricket was off for the summer, that all football was suspended until further notice, that the Formula One was off, that the Masters was cancelled, and of course it's now coming back in November. Basically no sport. So you can argue that was an even worse day than what the market has shown us. But then on the Monday, we experienced what was actually the worst day of the year, with the S&P going down about 12%. So it was really the doldrums that we were feeling and that we were finding ourselves in at that time. And no doubt all of you can remember the desperation and the panic that was enveloping us from all sides. In fact, if you look at CNN's business fear and greed index, something which they update on a daily basis, I do recommend that you go and look at it from time to time. I've included the full website address there in the source at the bottom. But on the 16th of March, you can see that the reading was basically as low as you ever find it, down at 3 out of 100, extreme fear. You can see how this compares to what we've seen in the last couple of years. In fact, what's interesting is how often it gets down at that level. You've probably forgotten about the panic that we had at the end of December 2018, which was basically just a profit warning by Apple and 1 or 2 related news items. That just shows you how volatile markets are. When we had a profit warning by Apple and 1 or 2 tech companies, the fear and greed index got as low as it got to in mid-March this year. And of course, this compares to the beginning of this year, which was an extremely bullish time with a reading of practically full marks, nearly 100 out of a possible 100. Be that as it may, the rest of March was quite volatile. The market kept on going down until the 23rd of March. And if you look at the calendar month of March, you will see that there's only been 18 worse months in essentially the last 100 years, since 1926. One of them was October 1987, which lots of viewers will remember. It was a dramatic month with Black Monday towards the end of October that year. Then the height of the financial crisis in 2008. And then August 1998, which was quite a memorable month as well. That is the then Asian financial crisis, which led to the demise of long-term capital management and certain other consequences as well. And except for those 3 months, all the other months that have been worse than March this year was probably not in the lifetime of anybody watching today. Of course, March at some point was a lot worse than this, because before the end of the month, markets started going up again, but more about that later. If we go to the end of March and we look at the calendar quarter, what you may not realize is this was in fact the worst calendar quarter in the history of the Dow, a history of now more than 100 years. And there was only one stock that was not down that month, and that was Microsoft, which managed to eke out a positive return of 0.1%. And I can say with some thankfulness that we own Microsoft, and most of our clients own Microsoft, but unfortunately we also own a number of the stocks further down the list which didn't have an equally good quarter. And in fact, if you look at some of the stocks that have since gone up and have reached all-time highs again in the ensuing months, you can see that stocks like Apple and Visa, as I say, stocks that have been strong since then, were also down double digits in the first quarter of this year. And if we just cast our mind back to where we were psychologically, emotionally, and intellectually at the end of March this year, I think that this quote from Howard Marks, who is the founder and chairman of Oak Tree Capital, one of the most respected firms in the US and one of the most respected commentators and authors in the world of investments today, he said this once, where he said that no amount of sophistication will allay the fact that all our knowledge is about the past, but all our decisions are about the future. And it's tremendously difficult to make those decisions when you're going through the kind of volatility that I've just illustrated in the first few slides. And that brought us towards the end of March, where my colleagues and I were feeling like Peanuts and Snoopy, sitting on the jetty, staring out in the distance, and Peanuts saying to Snoopy that someday we will all die, and it felt like we could be dying financially and from an actual health point of view. And Snoopy, in his normal philosophical self, responded, "True, but on all other days we will not." And one should sometimes take heart from that when you feel that the market is against you. And what Snoopy didn't say, but perhaps matters more, is that towards the end of March, investors also should have realized that the Fed had our back. Because if you look at what happened on the 24th of March, the 24th of March was the third strongest day in the history of the S&P 500. Only 2 days in the volatility of the financial crisis in 2008 were bigger one-day rises. But if you go back to the Second World War, we had the third strongest day on the 24th of March this year. And even though the headline in the FT suggested that this was based on hopes that the coronavirus spread was slowing, I would suggest a better headline would be that this was based on Fed stimulus, because the night before is when Jay Powell announced the first measure, the first package of measures that the Fed has announced. Since then, they've updated it once or twice, but some of the measures, the main ones, were announced on the 23rd of March, and that led to an immediate turnaround in the market. A couple of weeks later, I saw this tweet where somebody was questioning the fact that the Dow was closing up strongly in spite of the fact that the US at that point in time had gone to 10,000 deaths. Some people thought that that didn't compute. To which Colin Roche, somebody that I recommend people follow on Twitter, if you don't do so yet, he's one of the most sanguine voices and sane voices on Twitter, and you can learn a lot from him about the way the Fed behaves and everything that flows from it. He responded by saying that the stock market is indeed a second level thinking mechanism. The stock market is not responding on yesterday's news or today's news. The stock market is thinking about what lies in the future and is starting to discount that. And for those of you who've read the book by Daniel Kahneman about thinking fast and slow, this is classical slow thinking, which leads to a conclusion that maybe the market had overdone it and therefore should be going up, rather than the fast thinking, which is only focusing on today's news flow. A week or so later, this was the week just before Easter, we saw a picture which probably signifies what we've had in the market more than anything else. And that is Jim Cramer on his show on CNBC, where if you look at the burgundy banner there, it was listed that more than 16 million American jobs had been lost in the 3 weeks before that. But in spite of that, in the green lettering above it, we'd seen the best week for the Dow since 1938. And a lot of people were wondering, how does that compute? But as I've said before, if you do a bit of slow thinking, you can start explaining it. Of course, jobs kept going down. And I thought that this New York Times front page from the 9th of May this year was quite dramatic, where it showed that the number of jobs that had been lost had not only been worse than anything we've experienced since the Depression. You can see that goes back to the early 1940s. It's already a worse observation just on this screen than we've seen since the 1940s. But in fact, this doesn't tell the whole story. For the whole story, you need the whole of the front page, because in fact, that impact wasn't just worse than we've seen since the 1940s. It was 20 times worse than anything we've seen since the 1940s. That is how dramatic the job losses have been in the US and elsewhere. Truly a monumental impact from this disease and our response to it. In spite of that, as I mentioned before, the market has been strong. And in fact, April itself was one of the best months that we've seen since 1926. I showed you before how March compared to months over the same period. In this instance, only two observations would probably have been two better observations would have been in the lifetime of anybody watching today. And those were in January 1987 and October 1974. The rest of them all go back to the aftermath of 1929 and the Great Depression. To summarize, Ryan Detrick, who's the chief strategist at LPL Financial in the US, tweeted at the end of the second quarter that the S&P 500 had its worst Q1 ever, and it had its best Q2 since 1938. A dramatic turnaround very quickly as the market started working through the second level thinking. I asked the question here, how could the market have been so strong? And lots of people still ask that today. And in partial answer to that, I came across this newsletter which was shared by my friend David Shapiro in Johannesburg, with an extract there where it says that several investors seem to be baffled by the fact that stock prices have been going in the opposite direction from the trend of general business conditions. That sounds like it could have been written this year, right? Later in the newsletter, it comes up with the observation that it says that perhaps the reason could boil down to the surplus of funds available. Now you can rephrase that as Fed liquidity if you want to. And then further in the quote, the shortage of top quality stocks available for new funds. And you can rephrase that perhaps as the so-called stay-at-home stocks or the FANG stocks, something which I know that my colleague Jared Kahn will be focusing on tomorrow. Once again, it looks like that could have been written this year. But it wasn't written this year. It was written by Sir John Templeton in 1954. And if this proves nothing else, it does show that conditions may change, but markets, human nature, and investment behavior is ultimately universal and timeless. And I do suggest that if you can get your hands on this newsletter, that you read it, because as I say, it does look like it could have been written just the other day. Ultimately, the market overreacted in many cases. And just to illustrate a share that we do own, for the second quarter this year, on the 4th of August, Disney announced its results, and it showed the market that it had a 42% drop in quarterly revenue for reasons which are easy to understand. Of course, they couldn't churn out new films, the theme parks were closed, all sorts of reasons. Also, from the same announcement, they showed their first quarterly loss in 20 years. Not only is it their first loss, it was a loss of $5 billion US, a very large amount. And in spite of that, if you go and look at what happened on the 5th of August, which is the day after the announcement was released, the share price opened up 10%. Why? Because the results were less bad than the market had expected. The market realized that it had overdone the drawdown. At its high before the coronavirus, Disney was trading at about $150. It dropped down to about 100. And after these results, it got back to a level of about 130, roughly where it is today, by the way. In fact, it wasn't only Disney. If you go and look at the percentage of S&P 500 companies that beat their quarterly earnings expectations, which, bear in mind, this was expectations that had been updated downward, but still, in hindsight, updated, overdone in a downward direction. You can see that 83% companies, more than what we've seen in the last 30 years, beat their updated earnings expectations. And for those of you who are asking why have markets been so strong, this is the one slide that really underscores it probably more than most. With 83% companies outperforming updated expectations, you should expect upside in share prices. A very fresh slide, which is from earlier this week. Only a handful of companies, well, when I say a handful, a few handfuls of companies have now announced quarter 3 results. And if you just look at this slide, which is from Monday this week, you can see the strong estimate changes that have followed those results, and how that compares on the upside to those on the downside. So there are more companies that are still showing earnings expectations that are going up, and the quantum by which they're going up on average is also a lot more than for those that are going down. And once again, on balance, this explains why the market has been strong, and perhaps stronger than what many people expected. This is from just a couple of days ago. The IMF gave the updated economic outlook projections for all countries, and I just showed you one slide that summarizes it. And if you can see that for advanced economies in aggregate, they are now expecting a contraction this year of 5.8%, which, by the way, is less than what the same organization suggested it was going to be 3 months ago. So 3 months ago, they were expecting 8%. Now they're expecting 5.8%. Once again, the news is less bad than what we feared only a few months ago. And going forward, from the slightly lower base, they are expecting 3.9% for these countries. Of course, China is not on the slide. China is expected to be stronger next year. But for the advanced economies on the slide, on average, a growth of 3.9% expected next year, once again underscoring the positive market growth that we've seen. Just looking at what's been happening in the stock market on aggregate, as this slide shows, most of the action has actually been in the so-called FANG stocks, the largest 5 stocks in the world, which all happen to be technology stocks. And once again, I'll point out that my colleague Jared Khan will be focusing on this in his presentation tomorrow. But if you just go back to the end of July this year, you can see that in aggregate, those stocks, or on average, they were up 35%, while the rest of the S&P was actually down 5% at that point in time. Now, since then, the trend has been slightly better for the rest of the S&P companies, but it does paint the picture about where most of the action has been for the year to date. And of course, if you just roll this forward to the autumn, the Northern Hemisphere autumn, you can see that after the tremendous drop in business confidence and the fear and greed index that we saw earlier in this presentation, it had come nearly all the way back, a real V-shaped recovery in terms of the market psychology, the market emotion, the greed of the market compared to the fear experienced in March this year. And that also led to arguably my favorite tweet of the year by one Donald Trump. You've probably heard about him. On the 2nd of September this year, which was the high point of the S&P, the high point to date. Of course, this week, the S&P got to within touching distance of where it was on the 2nd of September, but we're still slightly below it. On the 2nd of September, Donald Trump said that the Dow has just closed at an all-time high of 29,000, and you have me to thank for it, because with Joe Biden, it would be crashing. Now, of course, this tweet was the top of the market, as I said. The very next day, the date is on this slide, the 3rd of September, you can see what happened. Technology stocks, more than anything else, started unwinding when people realized that SoftBank were caught in the unwinding of their futures position, and it had quite a dramatic impact. And I asked the question there, was this the first sign of a correction in tech stocks? If you just fast forward a few days, a week or more, it did look like it. You can see the FANG stocks in blue there had come down more than the S&P 500. I have to say that by the end of September, that relative position was still intact, but not by quite as much. So in September, the S&P 500 did marginally better than the FANG stocks, but in October so far, it's been the other way again. So only time will tell whether this was the first signs and what happens in the future. And once again, as I mentioned, this is very much within Jared's sweet spot in his presentation tomorrow. I will just try and answer the question, is there a bubble in the markets? And of course, lots of people are celebrating the fact that markets are going up, in spite of the fact that the economy is in the doldrums, in spite of the fact that the IMF says that the developed world will be going down by 5.8% this year. And just by focusing on one of the headline numbers, if you look at the multiple of NASDAQ relative to the S&P, in the late 90s, it went to an all-time high level in a period of 807 days. These are not market days, these are calendar days. So that's slightly more than 2 years. It's a tremendous run-up in a very short space of time. And of course, we all remember what happened with a crash, when the tech bubble crashed. And then since then, the NASDAQ has now reached the same multiple or a similar multiple to where it was at the height of the tech bubble. But instead of 807 days, it took 6,500 days. It took 17 years to get there. Not only that, but if you look at the largest companies in the world today, which dominate the NASDAQ, they are different companies to what they were before. These are strong, healthy companies that are actually making substantial profits. And I would therefore suggest that there's not a bubble as such. There may be a bubble in specific stocks, but in aggregate, I would not call a bubble for the NASDAQ. In fact, if you look at not the NASDAQ, but the Dow, and this is a very much updated slide. This is updated at the end of last week. At the end of last week, and roughly these numbers are still intact, at the end of last week, more than half of the Dow components were still down for the calendar year. And when I say down for the calendar year, this is not down from the high point in February. This is down from the 1st of January. So with more than half of them down, and with a third of them down double digits, I would really suggest that there's hardly a bubble in the market. If you look at the bottom right there, you can see some tech shares have done tremendously well, and we can debate the reasons for them, and lots of people will explain and say there's very good reason for most of them. But as I say, there's hardly a bubble in the market when more than half the Dow is still in negative territory for the year. In fact, Eddie Elfenbein, who's a commentator in the States and somebody who I also just suggest you follow on Twitter, he once came up with this quote where he says that a bubble is only a bull market in which you don't have a position. And it may sound slightly cynical and sarcastic, but I think there's some truth in it. If you go and look at what we've seen this year, you can see that in 100 days, and these are market days, so these are not calendar days, so this is more than 5 months. This is about 5 months. It's not 3 months, it's about 5 months in the market. From the low point towards the end of March to the 13th of August, the S&P gained more than 50%. That is the highest 100-day gain that we've seen since 1950. And you can see all the others that have been more than 22% over that period. And what LPL Research did in putting together the slide, it's extremely busy, but I'll highlight only one number. Or let me first show, there are columns here that says where the market was 1 month after this gain, 3 months later, 6 months later, and 12 months later. And to cut a long story short, and let's focus on 12 months, because 1 month, 3 months, and 6 months is maybe too short. It's maybe too noisy. But in 94% of the observations, in all the observations bar one, a year after this strong gain, the market was up even further. There was one example, which was in 1987, with the October 87 effect, which was part of it. There was only one example that was an exception to this. So the bottom line is that strong markets are a precursor to even stronger markets. And that is what we've mostly seen in history. One of the other reasons why markets have been strong boils down to low interest rates. And in fact, some of you that I've met maybe in the last year would have seen me use a version of this slide. We have seen decreasing interest rates for the last 800 years. This was published at the beginning of the year by the Bank of England, and you can see there the trend of interest rates. And for those who are forecasting interest rates to go up and to go up strongly, maybe you've got to realize that you're fighting history. You're fighting 800 years of history. Maybe there's a fundamental long-term historical reason why interest rates have been coming down and are likely to remain low for the longer term. And maybe it is illustrated by this very long-term graph. But if you just look at the yield curve, one of my favorite things to focus on when it comes to a presentation like this, the yield curve updated at the end of last week. You can see the zero line there. You can go out 30 years in both Germany and Switzerland and not see positive rates. You've got to go out more than 10 years in Japan to see positive rates. And you can go out a full 30 years in the UK without seeing 1%, and a full 30 years in the US and only see about 1.5%. And what this says, and that's not my interest rate forecast, this is the yield curve, which is determined by market behavior, by people buying, selling on a daily basis. The market is telling us that rates are going to be low for a very long time in the future and remain low. And from an equities point of view, that makes me very bullish. Why? Because the value of any financial asset, equities in this case, is ultimately the present value of future cash flows. And for that, you need a discount factor. And the first input into the discount factor is the risk-free rate. And when the risk-free rate is 1% or a fraction of 1%, as it is in the UK and the US at the moment, it does mean that equities, all equities, not only growth equities, but all equities can be trading at more elevated levels than what people have grown used to over their investment career. So long story short, a structural yield curve with rates such as the ones we're looking at here is ultimately quite bullish, not only for stock prices today, next week, next month, next quarter, but for the longer term. If there's one slide that's probably more important than any other in this presentation today, it is this one of Jay Powell, with a quote from the FOMC in mid-September, where he gave the commitment that short rates in the US would remain at zero until the US reached the Fed's definition of maximum employment, which is a quirky number of 4.1% unemployment, and inflation must be on track to moderately exceed 2% for some time. So he's basically saying that the Fed is going to keep short rates low for quite a long time, even if inflation goes into the inflation target band of 2% plus. And this is a very busy slide, but quite an important one. This summarizes and illustrates what JPL said in 16 September. So the inflation target, that orange line there, is set at 2%. That's been set at 2% for the last few decades now. And you can see how they've struggled in the US for the last 10 years since the financial crisis to get into that band. Inflation has been structurally lower than 2% for most of the last 10 years. I mentioned that the maximum employment is set at an unemployment level of 4.1%. We've got the red line running across there. And if you just look at what unemployment has been over the last, well, you can really go back 50 years if you want, but just focusing on the last 30 years, you can see that we only got to that level briefly at the time of the tech bubble unwinding. We nearly got there just before the financial crisis. And we did get there for a few months in the honeymoon period of Donald Trump's presidency when the economy was really pumping. But in the end, the Goldilocks period, or the Goldilocks band, which is where unemployment is low enough and inflation is high enough, where both of those criteria are met that JPL mentioned on 16 September, you can see that in the last 60 years, we've only been inside that band on 3 occasions. We had Goldilocks at the end of the Vietnam War, we had it just before the tech bubble unwound, and we had it for those few months that I mentioned earlier, the honeymoon period, the economic honeymoon period of Donald Trump. So where we are today with unemployment in the States, where the white dot is, and with inflation where the blue dot is, there's some distance to travel for both of these, not only to get into the yellow band, but to stay there for some time. Not my words, JPL's words. And that is why we are going to see low rates for a very long time still. Just to illustrate, if you look at selected prices in the US over the last decade or so, you can see that all item inflation has averaged about 1.7% per annum. As I mentioned before, under the 2% target rate of the Fed. Of course, anything transport related has been deflationary. And in fact, the most deflationary element is not even on the slide, that technology. Just this week, we've seen the new iPhone release. And of course, it is not more expensive than previous iPhones, but it is better, faster, more capacity, 5G. And all those elements are included in the inflation calculation. So everything technology-wise has been deflationary structurally for some time. And that is why, with technology being so prevalent, that is why the CPI number battles to really lift its head and get to 1.7%. I know a lot of people are calling for inflation in the wake of coronavirus and loose monetary policy, but we've been hearing that for the last 10 years, and I think the jury is out as to whether that's going to happen anytime soon. Just returning to interest rates, I mentioned Howard Marks earlier. Howard Marks, in his update a couple of months ago, spent the summer thinking about low rates, and he came to the conclusion that many investors may have underestimated the impact of low rates on valuation. And as he said in August, which is when the market wasn't at a much different level to where it is today, he came up with the conclusion that stocks may indeed have a very long way to go to increase from the levels that we are seeing today. And I think that does lead to a bullish conclusion, which is one that I would put forward today. Of course, the big elephant in the room, everyone knows, is an elephant named Donald Trump. And of course, the news flow for him in the last few weeks have not been good. We saw the book by Bob Woodward, who brought down the Nixon government with the Watergate scandal in the 1970s, and all sorts of allegations that are made in this book, which have been very damaging to the president's reputation. We saw the former Republican national security officials, 75 of them, buying space in the national newspapers in the US and saying that in spite of the fact that we are Republican and have always voted Republican, we think that Donald Trump is a national security risk, and therefore we will be voting for Joe Biden. And that has been quite damaging, once again, to Trump's reputation. We know about the New York Times and their revelations about Donald Trump's taxes, which came out a few weeks ago. And then I think a lot of you would have seen the debate, or an edited version of the debate, between Trump and Biden a few weeks ago. And most people agree that Biden won that debate in spite of the low expectations that many people had for him. But of course, debating success does not always translate into success at the polling booth. And we saw that in 2016 with Hillary Clinton winning all the debates but losing the election. And the same in 2004 with John Kerry winning all the debates, but George W. Bush winning that election. Of course, the most recent news item relates to the spread of COVID-19 at the nomination for the new Supreme Court judge, which happened a couple of weeks ago. If you just look at these red dots here, those are all the people that are said to have contracted the virus that day. And in fact, as I saw the summary the other day, there are now more cases of COVID-19 in the White House than there are in New Zealand. And the question is how this and the way that Donald Trump handled his disease, how that will affect his chances in the election. If you look at the real clear politics, they're not a political organization, they're an analytical organization. And if you just look at their summary of the polls, there's various versions of this. They all look similar. Biden really has a very strong lead of about 9 points, more than 9 points compared to Donald Trump. This is stronger than what Hillary Clinton had at a similar point in time, about 2 to 3 points stronger. And of course, the polls have been wrong. They were wrong in the case of Clinton. But with the margins being even bigger than before, most people are starting to believe that Biden, in fact, is very likely to win the election. You can see it in the betting markets as well. In the aftermath of the George Floyd incident at the end of May, you can see how Donald Trump's chances sunk. He then got it back through the summer with his message of law and order before the revelations of the last month or so, the ones that I've already highlighted, to get to a level today, which is essentially a 2/3 chance of Joe Biden winning compared to 1/3 for Donald Trump. But that doesn't mean that Donald Trump won't win. He still has many fanatical supporters. And in fact, you can go and Google this, those who didn't see it, a very interesting conversation between Tom Keene from Bloomberg Politics and Rudy Giuliani, the former mayor of New York, Giuliani being one of the cheerleaders for Donald Trump. There are some very strong voices that are still supporting Donald Trump. And in fact, this is something which I found very interesting. Last weekend, Charlie Bolello, who never tweets about anything politics, once again, he's just an analyst, he tweeted to his 190,000 followers. He asked them who will win the presidential election. This is less than a week ago. And 18,000 people cast their votes. You can see my little tick mark there. I thought Biden. But 53% of people still think. This is 53% of people essentially involved in some form or shape in Wall Street, because those would be the only people following Charlie Bolello. He's very much an investor. He's not a politician, and there's no other interest if you follow Charlie Bolello. 53% still think Trump will win, in spite of what the betting odds are. Of course, this does compare to a similar poll that Charlie Bolello did a month earlier, which showed 62% for Trump. So there's been quite a big decrease. The question is where this will be in a few weeks' time. I think the jury is out and anything can still happen. Of course, if you go and look at the market impact of whether it's the Democrats or the Republicans winning, it's quite mixed, actually. This was done by Citi Private Bank. And therefore, a lot of people will tell you that the Republicans are better for the market. And on balance, I think they are. But if you look at this picture, you can see that it's actually more mixed and more nuanced than what some people realize. Of course, the big thing is that the consumer discretionary sector, which is largely Amazon, and the technology sector, which is most of the other big technology companies, both of that favors the Republicans. And that is important because of their size within the indices. But be that as it may, as a very recent New York article suggested, Wall Street has been warming to the possibility of a Biden presidency. And as StreetInsider.com reported just a few weeks ago, Goldman Sachs came up with a conclusion that a Biden victory would be good for stocks. Why? Because on average, there would be a 4% upward revision by 2024 to baseline earnings forecast compared to where they are today. So Wall Street has been changing their mind and have been warming to a Biden presidency in case he wins, in spite of all the typical counter arguments for a Democratic presidency. It was summarized, I mentioned Goldman Sachs a minute ago. The ex-CEO of Goldman Sachs, Lloyd Blankfein, just a few weeks ago tweeted this, and he said that it seems like the market is comfortable with higher taxes and increased regulation that a Biden government will bring, rather than the nastiness and scorched earth that we've seen with Trump. And maybe there's some truth in that. In any event, as I say, this is just from earlier this week. The market has indeed been strong. As I mentioned, the S&P is within touching distance of its all-time high. And most of these FANG companies are likewise as we speak. Just very quickly, looking at the previous election. I woke up, you can see the time there. This is a screenshot that I took myself the morning after the election at 5:44. This is midnight in America. And the futures were down about 5%. I came to the office, and Japan, which of course was open overnight, was down 5%. And by the time that the market opened, the American market opened, you can see the Dow was down only 0.3%. That minus 5% position worked itself out of the system even before the market opened. the market very quickly got used to a Donald Trump presidency even before the first market opening. And in fact, if you look at the slightly volatile but sideways movement for the few months before the election, the market started going up straight after the election and has kept on going up, about 40% higher today than where it was after he'd been elected. And in fact, as Ben Carlson illustrated just a few days ago in a blog post, you can see that the market, the US market, has been strong across presidents and across political parties. And ultimately, this bodes well, regardless of who wins the election. Just finally, a few thoughts on gold, because I know it's been popular amongst a large percentage of investors this year. And ultimately, I can tell you that I've been basing my own view of gold on what Warren Buffett said 22 years ago, where he said that gold gets dug out of the ground in Africa, we melt it, we dig another hole, we bury it, and then we pay people to stand around guarding it. It has no utility, and anyone watching from Mars would be scratching their head. And I still think that's largely true 22 years later. Now, of course, Warren Buffett did turn 90 just a couple of months ago, and Bill Gates bought him a cake on that occasion. So maybe he himself doesn't remember what he said 22 years ago, because Warren Buffett, of course, or Berkshire Hathaway at least, were reported to have bought as much as $500 million worth of gold in the summer. Now, to a lot of people, that may sound like a large number, and you will think that it's a substantial investment for Berkshire Hathaway. But if you bear in mind that Berkshire Hathaway this week has a market capitalization of $500 billion, you will realize, and I hope you can see that little gold bar on the bottom left of the picture, you will realize how small gold is in the life of Berkshire Hathaway. That's hardly a hedge. That's hardly a bullish position. Just to put it in perspective, we all know that a company called Snowflake listed a few weeks ago. Snowflake, post its listing, is 3 times the size of the gold investment within the Berkshire portfolio as we speak. And just to put it in more perspective, Apple is about a quarter of Berkshire Hathaway today. So once again, I don't think that that gold hedge amounts to that much. Crescat Capital in the US a couple of months ago published this graph, and they were extrapolating that trend towards the end. So that yellow arrow was from their report. I've changed it and said, you know, this to me looks like a structurally underperforming asset over the last 35 years or so. And if anyone tells you that gold has reached another all-time high or a 2-year high or a 10-year high, my response is that Microsoft is also at a 2-year high, a 10-year high, and an all-time high. And I'd rather be in Microsoft than in gold, as just one example. The bottom line is this, as Stanley Druckenmiller once said, there are a lot of shoes on the shelf, and you should only wear the ones that fit. And speaking for myself, the gold shoe has not fit me for 20 years, and I don't plan to try it on anytime soon. Ultimately, I remain long-term bullish, as I've been for some years. You may be buying at an all-time high if you buy it today, but buying at all-time highs has been a winning strategy for 400 years because there's been lots of all-time highs along the way, and that is not in and of itself something that should put you off from investing your money into equities. This is a picture which I took on a run a few months ago, not far from my house in London, and there's 2 messages here. And one is that I look forward to next year when hopefully those teddy bears that we saw on the chairs outside the street cafe in Paris have been consigned to the bin because we don't need all the social distancing anymore. But also symbolically, the second message is I would urge investors to consign their inner bear to the scrap heap and ultimately believe that there's a reason to buy equities and to remain optimistic about the longer term. As Victor Hugo said in Les Mis, even the darkest night will end and the sun will rise. So whether your dark night consists of COVID-19 or Brexit, something I didn't really talk about today, but once again, Jared will address that tomorrow, or Donald Trump or Joe Biden for that matter, ultimately the dark night will end and the sun will rise. As Queen Elizabeth said to the nation in April this year, we will be with our friends again. We will see our clients again. We will meet again. And the world, I believe, will be whole again. And on that note, I just want to thank you for your attendance and wish you well for the next year until we all do meet again. Please bear in mind that all our presentations are being recorded and will be made available online later. I think we can make the slides available as well on request. And as a parting thought for myself, just to mention that this presentation of mine will be followed in a few minutes' time by my colleague Charles van der Merwe, who will be talking about the Credo platform. As Alan mentioned at the beginning, you need to log on for that separately via the link that has been sent to you, those of you who have registered with that, and that will start at 10 o'clock UK time, 11 o'clock South Africa time. So thanks once again, and goodbye.